Hi everyone, welcome to Clone Compounding, where our mission is to learn from others in order to achieve financial independence. This video is the fifth episode in the multi-part series in which we're looking at the key lessons from the legendary investor Warren Buffett in his letters to shareholders over the last 40 years. Warren needs no introduction. He's the chairman and CEO of Berkshire Hathaway, one of the largest conglomerates with businesses covering insurance, railroads, food and beverages, and even tech. In today's video, we'll be covering how Mr. Buffett identifies the moat of a company. This means, how do we know whether a company has a sustainable, long-term competitive advantage over its peers? This is part one of two videos that we'll be doing on key definitions of a moat. To view earlier videos in this series, check out the description below or head over to the channel's page. Before we start, please smash that like button and make sure to subscribe to receive the next videos in this series on key lessons from Berkshire shareholders' letters. Now, let's dive into the 5 rules to identify the moat of a company, as per Mr. Buffett. Number 1. Gross profit margins. If a company can sustain a gross profit margin higher than 40% consistently, then the company very likely has a strong moat. Gross profit margin is defined as gross profit divided by total revenue. You can find this on the income statement of the company's financial report. According to Mr. Buffett, a consistently high gross margin shows the company doesn't have to compete exclusively on prices of its products or services, and it also provides funds to pay expenses and leaves money for shareholders, that's dividends or buybacks. Good examples of such businesses are Meta at more than 80%, Microsoft at more than 65%, and Alphabet at more than 55%. Number 2. Net profit margins. Net profit margin is defined as net income divided by total revenue. You can find this on the income statement of the company's financial report. If a company has net profit margins consistently above 20%, it's likely to have a strong moat. According to Mr. Buffett, if a company is able to consistently convert 20% of their revenue into net income, it means that it has a strong competitive position. If this number is under 10%, negative or volatile, it's an indication that the competition is fierce. Good examples of such businesses are, again, Meta at more than 25%, Alphabet at more than 25%, and Apple at more than 25%. Number 3. Sales, general and administrative expenses. SG&A expenses are the day-to-day costs a business must pay to operate, whether or not it manufactures products or generates revenue. You can find this on the income statement of the company's financial report. Having SG&A as less than 30% of gross profit consistently is a sign of a moat. Wide moat companies, meaning companies with strong competitive advantage, don't need to spend a lot of money on overhead to operate. Again, good examples include Apple at 14% and Alphabet at 25%. A not so good example on this is Amazon at more than 60%. Number 4. Depreciation expenses. Depreciation expense is the portion of a fixed asset that has been considered consumed and then charged to expense. The intent of this charge is to gradually reduce the carrying amount of fixed assets as their value is consumed over time. For example, if you bought a car, which is a fixed asset, every year its value depreciates by a certain amount. You can find this on the income statement and cash flow statement of the company's financial report. According to Mr. Buffett, a company might have a strong moat if its depreciation expense is less than 10% of the gross profit. If it is consistently less than 10% of gross profit, it's a sign that the company does not need a lot of capital expenditure to maintain its competitive advantage. Good examples will be companies that don't need high amounts of capital expense every year to sustain their business. Not so good examples will be companies that do. For example, capital-intensive companies such as oil and gas firms. Number 5. Interest expense. An interest expense is the cost incurred by a company to keep its debt obligations. In other words, it's the interest to be paid yearly on the borrowed funds. Interest expense is a non-operating expense shown on the income statement of a company. According to Mr. Buffett, great businesses have such amazing economics that they don't need debt to grow and can sustain their growth based on the cash the company is generating on its own. Having interest expense less than 15% of its operating income consistently is a sign of a moat. Again, a good example here would be companies like Meta, which has zero interest expense. That means it has no debt. For now, that's it in part 1 of this 2-part video on identifying the moat of a company. Hope you learned from this, and make sure to subscribe to receive the follow-up videos on key lessons from Warren Buffett's Berkshire letters. Be sure to smash that like button. Thanks for watching and subscribe for more.